Global banks, they've been under pressure this week following the collapse of Silicon Valley Bank in the United States. Since a run on customer deposits caused SVB to go under, we've seen the contagion spread to Credit Suisse in Europe and other lenders in America. I caught up with Mr Sherwood, the head of investment strategy at Perpetual, and started by asking him if these collapses had taken the market by surprise.
Well, Fed tightening cycles always end up breaking something, so something being broken was not really a surprise, but a collapse of a bank's always something that not only surprises market but also concerns markets, because banking is a confidence game more than anything else, and so when a bank fails like that, people always worry about contagion risk and blowout in funding costs and higher risk premia, so it always has a pretty violent market reaction, and this time was no exception.
Yeah, there's a chart we can put up on the screen showing regional bank performance in the United States. It looks like it's becoming clear that Silicon Valley Bank is just the first of many banks in America that are under a lot of pressure right now.
Yeah, they certainly are. I mean, and whilst people are talking about idiosyncratic risk, with relation to Silicon Valley Bank, I think there's a lot of commonality is what's happening with all these banks. They're under deposit funding pressure because of the rises we're getting in US interest rates, and people now can get better returns by buying treasury bills, for example, which are backed by the US government, and of course a lot of these institutions also have gone pretty long in government bonds, which have lost a truckload of money, even though they are supposed to be safe, and that's causing all kind of eruptions and fear and contagion risks in markets. So the one thing's for sure though is that the Fed package that they've got together isn't really, they say that they will bail out uninsured depositors, they will provide liquidity, so that stops the bank runs and having to fire sell assets. But in the end, the banks are under pressure, particularly through their margins. They're going to have to tighten their lending standards. They've been downgraded, some of them to junk. As a result, you can see their share prices have stopped falling, but they came off a hell of a long way. And they're just, tiptoeing around at the bottom.
Yeah, and the latest bank to come under pressure has been another smaller lender, First Republic,
Yep.
And it looks like a large group of American major banks have tipped in $30 billion to help prop that up. And markets seem to be stabilising now off the back of that move?
Yeah, because the big banks are actually putting their own capital in rather than saying to that bank, you need to go to the Federal Reserve and get some help. But it's probably a sign that the market wasn't really confident in the Fed's plan. Because in the end, there are two pressures on margins. There's two pressures on regional banks. First one is the financial system strains, which I think that the Fed plan actually will address. Mm-hmm. The problem, though, is those banks are just in a world of pain at the moment. Their margins are under pressure. Lending volumes are going to go down. They still have the losses of these treasury securities. The lending they're doing probably is losing money as we speak. So the operating models are still very strained at the moment. And at the moment, they just need some funding. So the fact that the big guys in town are lending money to them, probably something that the markets like better than everyone just running to the Federal Reserve.
And then we've got the situation where Credit Suisse in Europe is also under pressure. What's the sort of correlation between Credit Suisse's situation and the situation in the United States?
Well, everyone's worried, as I said before, about contagion risk. So they are looking for signs of stress. And Credit Suisse has been a very poor performing bank for a long period of time. So before this week, the share price was down around 94% from its all-time peak. So that's more than what the US share market lost in the Great Depression, where 40% of banks actually failed. So it's a firm that's really struggled. Obviously, they were looking to raise some capital and needing to in this environment. Their biggest shareholders said no. That's never a good sign. And so all in all, they had to go to their own central bank and kind of beg for some capital, which they've been granted. But in the end, it's all of these needing liquidity and needing capital in very difficult times that we're now in. And it all kind of goes back to the fact that central banks were really late to this tightening cycle, and that means they have to go very, very aggressively. And that's had two key effects. One, it means that banks and the private sector themselves hasn't had a lot of time to adjust. And secondly, the central bank hasn't had a lot of time to actually analyse how the private sector and the financial system are adjusting. So they're hiking now in a period of pretty high financial risk.
So, Matt, US Fed, they meet next week, and then the Reserve Bank start of next month. But what do you expect from the Federal Reserve and then our own Reserve Bank? We've got a chart we can put up showing inflation in America. Obviously, it looks like it's still too high over there.
Yeah, well, the problem was the markets all became optimistic about the inflation outlook in the US, and it was really just driven by transitory disinflation in energy and goods sectors. The gold part of that chart, which is the services inflation, that's far more secular, it's more permanent, it's never come down more than 0.5% without a recession, and at the moment it's just far too high. What the Fed does this week, I think they probably still move to tighten rates, probably by a quarter point. And futures markets and bond markets say there's nothing else after that. But, you know, I suspect unless we have some kind of calamitous event economically or financially, they will continue to grind interest rates up because they need to go higher than what they are to get that core inflation rate back to their comfort zones.
And really quickly, RBA, will we see a pause or not? I
think the RBA is much closer to pausing. We have this big interest rate war coming as people move off the fixed rates to the variable rates. Australia doesn't quite have the inflation backdrop because the wages here are very contained at the moment. So potentially one more, but I think after that, you know, the RBA will be pretty content to sit quiet.
Matt Sherwood, Head of Investment Strategy at Perpetual, thanks so much for your time.
Thanks for having me.